A few years ago, two companies looked unstoppable. Alok Industries was expanding at full speed. Future Retail's Big Bazaar stores were packed. From the outside, both companies looked successful. But behind the scenes, their balance sheets were cracking. A crack caused by one number most investors don't even look at: the debt to equity ratio. Alok's debt to equity hit 8 and Future Retail crossed 9. And eventually both collapsed under the weight of their borrowings. Today, we decode this one ratio that exposes this hidden risk so that you never get trapped just because a company looks good. Let's start by understanding what this ratio exactly tells you. Debt to equity or DE tells you how much debt a company uses compared to the money shareholders, that's people like you and me, have put in. Let me simplify this further. Let's say your business needs 100 rupees. Now you can either raise all of it from shareholders, that way your debt will be 0. Or you raise 50 from shareholders and borrow 50, which makes the debt to equity ratio 1:1. Now watch how your returns change based on debt. Let's look at case 1. No debt and profit of 20 rupees means your profit margin will be 20%. And case 2. Let's look closely. Half debt, that's a 50 rupee loan at 12%, leads to interest payment of 6 rupees. So profit after interest becomes 14 rupees. But since your equity is only 50, your profit margin will be 14 divided by 50 rupees. That's 28%. Suddenly your interest looks higher. And this is the exact trap. Debt amplifies good years but destroys bad years. Because lenders don't care about business cycles. Interest has to be paid. Always. So what's a healthy DE ratio? Different industries have different norms depending on the company's industry, nature of business and scale of operations. But as a general benchmark, DE above 2:1 is where risk starts rising sharply. Think of it this way. You put 1 rupees, bank and lenders put in 2. That means lenders have twice the claim on the business compared to you, the shareholder. And as this ratio keeps rising from 3:1 to 4 to 6:1, the risk doesn't just increase, it multiplies. Now let's revisit the companies we spoke about earlier. Alok Industries. It was one of India's largest textile manufacturers, making yarn, fabric, garments and home textiles. As an investor, if you looked at Alok Industries between 2007 and 15, everything looked promising. Revenues rising fast, capacity expanding, new verticals, new markets, profit showing up. But here's the real picture most investors missed. Let's look at the financial information of Alok Industries from FY 2007 to 2017. Notice how debt multiplied 8 times and interest cost grew 36 times by 2017. But revenue stopped growing and profits turned into massive losses. Why? Because the growth wasn't coming from business performance, it was coming from borrowed money. Alok borrowed heavily to fund new spinning units, retail stores and even a UK venture. But those investments didn't deliver the cash flow needed to repay debt. So by 2015, interest itself became one of the company's largest expenses. Think about it. You can't keep paying 3,000 crores in interest every year when you're making losses. By 2017, Alok Industries was drowning. Its lenders had over 30,000 crore at risk. The company defaulted and the RBI placed it among India's 12 large stressed accounts sent to the Insolvency and Bankruptcy Court, that's IBC. In 2019, Reliance Industries and JM Financial ARC acquired it, with lenders taking over 80% haircut, recovering just 5,000 crore. Alok's PAT once looked healthy because equity was small and profits were boosted by borrowed money. But that was leverage, not efficiency. When the cycle turned, the same leverage destroyed the company. So the lesson for you as an investor: high profits without cash flow and high debt is an illusion of success, a collapse waiting to happen. Now let's look at another giant you've probably visited many times. Future Retail, the company behind Big Bazaar. For years, Big Bazaar symbolized modern retail in India. Thousands of stores, household names, and massive reach across cities. In 2017, the company's borrowings were around 1,000 crore, By 2020, that shot up nearly 9 times, crossing 8,800 crore. At the same time, reserves turned negative, meaning the company's liabilities were now bigger than its own capital. The debt to equity ratio grew from 0.42 in 2017 to 9.33 in 2021. Then came a slowdown in retail, heavy lease costs and the pandemic, and the debt turned fatal. By 2022, Future Retail had defaulted on loan repayments. Suppliers stopped supplying and banks dragged it to bankruptcy courts under the Insolvency and Bankruptcy Code. Once India's most recognized supermarket chain was reduced to liquidation level value. The lesson here is simple. Revenue builds a company, profit grows it, but excessive debt can end it. Now that we have seen what excessive debt can do, let's look at the opposite story. One of India's most disciplined retailers, Avenue Supermarts or DMart. DMart has been steadily reducing debt every year while opening stores at a record pace. Same sector, same country, same decade. The only big difference? Debt to equity discipline. In retail, the ideal D is usually around 0.5 to 1.5. Above 2, survival becomes harder because retail operates on thin margins. Now let's break down DMart's debt to equity trend. 2014 to 2016, DMart operated with moderate debt. That's 0.7 to 0.8 D to build its initial store base. Then after the IPO, borrowings dropped dramatically. Debt fell from 1,497 crore to 38 crore by 2020. And if you look at 2020 to 25, you will see that the financial borrowings are zero or negligible. Net worth jumped from 11,000 crore to 21,000 crore. D effectively became 0.00 for 5 consecutive years. And this debt reduction played significant role for growth of DMart. No interest burden led to more cash for expansion. DMart reinvested profits directly into new stores and strong return on capital. Two companies started in the same industry. One took on more and more debt and collapsed. One avoided debt and became India's most successful retail chain. So here's what you as an investor should walk away with. PAT tells you how efficiently a company makes profits. Debt to equity tells you how safely it does it. So next time you come across a company that looks too big to fail, don't just look at profits or brand value. Look at the debt to equity ratio. It tells you what the glossy numbers don't. And if you want us to decode another financial ratio next, tell us in the comments below. And if you found this video helpful, don't forget to like the video and subscribe. See you in the next one. Now let's look. Sorry. Yeah. सही था अच्छा.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.